All right, stock started off the day relatively weak. We had a surprise uptick, well, a slight uptick in jobless claims, but really the big news out of Walmart with a big earnings miss and at least a negative market reaction to their earnings. Walmart blaming the possibility of tariffs on future guidance and what the negative impact that they could have on their business. That sent their stock dropping, as well as some of the major banks out there also ended up having a really negative. In fact, I think the biggest negative contributor to the Dow today was a couple of the big banks. So really a sour way to start off the day. And actually ended up kind of near the lows for most of the day until the end, last hour or so the market rallied. Ended up with a nice little move to the upside to finish, which is kind of the standard pattern. So we ended up not being down nearly as much by the time the day was over. So it ended up being a kind of a good day, especially overseas, especially in emerging markets. Ended up being a very, very good day for emerging markets and Chinese stocks in particular. So we're going to break down kind of what drove the markets today, the impact that it had on different technical indicators that we watch, and what we can expect to see, of course, going forward based off of what these indicators are telling us, what to watch for tomorrow and into next week, and how likely we are to maintain this current intermediate trend that we're on, of course. So we'll break all that down. Sector rotation, very surprising sector rotation. So we'll talk about that. Considering that we're all-time highs, we don't necessarily have the sectors that are leading us that we typically want to be leading us when we're at all-time highs. So we'll break all that down, and then our trade ideas. One of the mega cap names, this chart is actually not starting to not look so good. So we'll talk about how to trade that. So let's go ahead and get started. Today is Thursday, February the 20th, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades that we've done in old Market Outlook videos, see whether we should actually stay in them or get out of them. We talk about how to manage them. Come to the bottom, click this heart. It opens up this tab here, hit that like button. Same thing here, click this thumbs up icon. It opens up this tab, hit that like button right there. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do this day in, day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we ended up with a down day today, but we were way off of the lows, so it wasn't nearly as bad. In fact, we barely closed below yesterday's open, so it really wasn't that bad of a decline. We're still 1.5% above the moving average. As you can see there, the dark green shading and the green line still on the market forecast. The intermediate line's at the 96th percentile. Like it's hard to be too bearish when the intermediate line is that positive. The market sentiment line just turned higher today, so it's rising now in bullish levels. The intermediate line is above the market sentiment line. The near-term line dropped, but that's okay. That happens, right? It's these near-term rallies only last 7 to 12 days on average. As long, this was clearly a bullish. I mean, it's not even over yet because it doesn't end until we're out of bullish territory. But even if it is, say, tomorrow, it's clearly a bullish near-term run. So we're coming off of a bullish low point. You'd expect the next low point to be bullish too. Again, unless the momentum line is like deep in to oversold levels tomorrow. If the near-term line drops below 60 tomorrow, and the momentum line is at deep and oversold levels, then we'd be concerned about a bearish near-term low point. But they usually come after bearish near-term peaks. And this usually isn't. Obviously isn't one. It's hard for it to go from a strong bullish near-term peak to a strong bearish near-term peak. That doesn't happen. The vice versa happens quite a bit where you go from bearish to bullish. But it's not too common to go from strongly bullish to a strong bearish posture. It can happen, of course, but it's not as common. So I'm not too worried about any decline here. As you can see, we're still, like I said, well above the moving average, close to all-time high. We just got an all-time high yesterday. So everything is just fine there. If you look at the NASDAQ 100, it looks pretty similar. Dark green shading in the green line, strong near-term, strong intermediate posture. The near-term line still in bullish territory despite its drop out of the reversal zone. Market sentiment's falling, but at least it's still in bullish territory. And again, like the S&P, the momentum line's like, there's no issue with the momentum line. It's not even close to being strongly oversold. It's bouncing back up above the chart's midpoint. If you look at the Dow Jones Industrial Average, it's a little different. It's a little bit more bearish today because of the Goldman Sachs and JP Morgan, which are big components of that, or Morgan Stanley. Two of those three, at least, are in there, if I remember correctly. Walmart also smaller component, but still smaller weighting, but still had its impact as well on the Dow Jones. As you can see, the intermediate line still in the reversal zone, so we're still strongly bullish. But we did not get a bullish near-term peak, and the near-term line is now below 60. Now, granted, again, the momentum line is below the near-term line on this day one of its falling. We did not cross 60 and 50, so we only crossed one line, not two or three. That's when you really start to worry. And then again, your momentum line was not in oversold levels, especially at deep oversold levels. So no issue, no concern necessarily there for the Dow Jones Industrial Average, despite it's barely, now it's only about 0.25% above the moving average. So it's a lot more weaker from that regard. And then finally, your Russell 2000. Remember, the Dow is price weighted, so it's a little different there. But the Russell 2000, which is not price weighted, is also, and is a lot more broader than the S&P 500 because it's not dominated by mega caps. It's below, like it's moving. The stock dropped below the moving average. The moving average has already dropped, so it didn't even get a yellow line. It's already red. So we're below a falling moving average. But again, the near-term line dropping below 60. It had dropped below 60 barely yesterday, 58.8. So technically that was day one. But the reality is today, we did cross two lines today, 50 and 40. This is really day one. When you're not that far below that line, and again, your momentum line is not oversold at all. It's below it, but it's not oversold at all. So you really don't have it, and it is a bearish cross of the near-term line because they're both between the reversal zones. But it's not really a big issue right now. So a little bit of weakness today, but you're going to have, every day is not going to be an up day when you're in a bullish trend. You're going to have some down days mixed in there as long as they're not significant, and that's kind of what we're seeing with today so far. If you take a look at the weekly chart, give it a second to load up here. Again, strong, a good bullish candle. We're still above that 5% mark, 5.25%, so we're still okay. We're higher close, higher high, higher Heikin Ashi close, so that all looks good. When you look at the three green arrows, we definitely have three green arrows on those two indexes, the S&P and the Dow. Your Dow, or S&P and the NASDAQ. Your Dow, of course, does not. It actually has now two red arrows with the stochastics rolling back over. And your Russell 2000 almost back to three reds because your stochastics is barely rising. Otherwise, we'd have three red arrows again on the Russell 2000. So much different story on the right side of this page than over here on the left side, which again, this left side is market cap weighted and dominated by a literal handful of companies. Let's take a look at the two-line version of this chart. And you see here that the S&P, again, is still well above them. In fact, today at the lows, we were still above the 17-day. Really, we don't get going on any kind of weakness until you're both below the 17-day exponential, the red line, and the MACD is below its moving average. So obviously, we're not in either, especially with the rally off the lows. We're still above the 8 days. So again, no weakness there from that perspective. If you look at the Dow Jones, it's a little different story. We are below the 17-day, and the MACD is below its moving average, so that's not a good sign. In fact, we closed below the 8 and the 17, and the Russell closed below its 30, with the MACD below its moving average and actually negative here. So much different story on those two averages versus what we're seeing in the large caps indexes. All right, now let's take a look at the DMI, some of these other oscillators here. And you can see the DMI, again, the ADX has plummeted. Like there literally is no trend going on right now. on the S&P 500, at least according to this particular indicator. When the ADX, like you can see, it's never been this low. In fact, the last time it was below 10, which is an extreme level for either of these lines, was way back here in July of 2021. And we actually had a pretty decent trend at that time, but we had the ADX was barely above 20 when it started the drop. And so you can kind of see we had a bullish move going, and then we just kind of stalled right here. And during this kind of sideways movement, we were so sideways, it brought the ADX down. That was the last time. This is like August of 2021. And again, we came from just barely being above 20. Well, here we came from being above 30, and we dropped like a rock all the way down to 10. So bigger drop and a steep, and a lower level, and we've really been sideways this entire time. If you take a look at the RSI and the CCI, they're still relatively up. I mean, neutral levels, and bullish towards the upper end. We just barely came off a pretty significant high here. If I can just keep this going, we'll just keep this going here. It's pretty significant level there on the CCI. Like getting above 150 is pretty bullish. The RSI barely got above 60, but it did, and it is at least above 50. The RSI being above 50, the CCI being above 0, both at relatively bullish levels, even if they're not strong bullish levels right now. So there is a bullish bias to this sideways trend that we've been on. And then you look at like the Ichimoku cloud, and you see that, okay, well, we are now on the cusp of an intermediate strength trend. You have to get above 2, you have to get above 65. We're on the cusp of that. Now, sometimes these levels can act as some resistance here, and the trend can just stay weak and we fail. So that's something we need to keep an eye on, especially as, again, we're kind of approaching this mark. We're above it slightly, but we're kind of approaching this little move to the upside. And, that's, if we cross through it like it did over here, that usually happens on a downward move. This is the red line is today's close plotted 26 days prior. So that's something we want to stay above all of this mess. We don't drop through that line, which ends up being pretty bearish. Again, the cloud's green, so we're not bearish at all. But remember that that's not the case on the other indexes, right? The Dow Jones, we were pink, at least we're above it. But you see, again, how susceptible we are to crossing through and having a negative rate of change. We do have an intermediate strength trend going still on the Russell, and the small cap index is actually below the cloud, at least flirting with the bottom of the cloud, and flirting with getting below both the green and the blue lines. And you can see, again, that same kind of rally that the red line is in danger of crossing through, again, with no trend going on here right now. All right, now let's take a look at the Bollinger Bands. Again, the bandwidth is so extreme. Even with this little bump we've had, it's still so extremely low. We are still in the upper quartile of the bandwidth, however, as small as it is. And the momentum is still relatively bullish with red dots. The bands are still inside the Keltner channel. So it's a little different story on the Russell. The bandwidth is pretty low. We are not in the upper quartile. In fact, we are in the bottom quartile of this really narrow bandwidth that is deep inside the Keltner channels. And again, negative momentum here with the red dots. So, again, both indexes are coiling. It's just a matter of which direction are they going to break out of. The S&P would suggest that we'd break out through the upside. The Russell, on the other hand, would suggest that we'd break out through the downside. So much different story for both these indexes. Finally, let's go to the intraday charts. Of course, we did have a lower high and a lower low, but the late rally got us above yesterday's low. That's very positive. We're still below last week's high, so a little bit, little weakness there, but at least we closed above yesterday's low. So not as bearish of a day as it could have been. IWM did not, right? So we clearly broke below yesterday's low. We closed below yesterday's low, lower high, lower low. And when you look at the stochastic indicator here, the S&P is still at bullish levels, but the Russell 2000 is not still at bullish levels. It's actually in bearish territory. It's below the 40th percentile, and below the moving average. Moving average is falling. So much different story there. Bearish pattern developing on the Russell 2000. Today's volume and trading range was relatively light, bigger than what we've seen on the volume side at 36 million. The range a little bit bigger than what we've seen too, 4.66 points, but still below the average. And so the average, the ATR is still down below 1%. The volume is falling still to extreme lows. Again, it's not common to go to 52-week lows on the volume, and that's where we're not going to go to new 52-week lows, but we're really close. And again, absent this little kind of pre-Christmas drop in volume, this would be the 52-week lows, at least really right on it. So pretty extreme drop in the average volume there. Let's take a look at the volatility index. We always like to look at the VIX and see what it's doing. The VIX is still above 15. It's still at bullish levels below the 90th percentile, centered around the 85th percentile. The correlation is dropping again. Right, this is something to keep an eye on, because usually when you get a drop in the correlation, it precedes a jump in volatility. We saw that. I mean, even when you just get below 75%, usually it's especially below when you're below 0 or below 50%, which is this blue dotted line. But even at below 75%, this preceded a jump in volatility. This preceded a jump in volatility, and now we're below 75%, and the VVIX is still hovering right around 95. So again, getting below 90 is kind of the key there, and the closer it stays to 100, the more susceptible we are to a jump in volatility, right? That's kind of the idea that's looming. That kind of move is looming there, especially considering now is the seasonal time of year for that to happen. We did trade above the 200-day average on the VIX at the highs of the day today at 16 and 2/3. So that's something to kind of keep an eye on over the next tomorrow and over through next week, is that susceptibility to a jump in volatility, and especially when you have the skew as high as it is. When you look at the skew index here, it hit its highest level ever. Where is it? Here it is. It hit its highest level ever yesterday at 183. Today at 175. It's obviously not the highest level, but still pretty extremely high, very extreme. Remember, anything above 150 is extreme. We've been above 150 now for going on 4 months. We've been above this extreme level. That's the average has been above 160 for multiple weeks. This is a high level of risk aversion, but not like in the near term. Like, this is a high level of risk aversion for bigger moves, for longer, bigger moves. That's what the market is anticipating. They're usually about a 2 standard deviation move. And then, like I said, the VIX relative to VIX 3M suggests when the VIX is as low as it is, especially combined with the high skew, it suggests that the VIX 3M is higher, relative to this. So again, a lot more demand for longer term risk protection and bigger risk protection versus your standard pullback, which we've been talking about. That's one reason why the VVIX is so high too, hovering around 100, because again, the market still is got a little bit of concern built out there, even as we end the earnings season here with really only Nvidia's earnings left. From a mega cap name standpoint, as we're ending, you would think that volatility would start to dry up, and there's still a lot of demand for it out there, even if in the near term we're still very complacent. All right, now let's talk about what's driving the price action. Look at this 3-month return on gold, 11% return, just for some perspective on just how significant that is. Let's come over here to the rated, whoops, not this one, sorry. Well, we can actually look at this one, the linear regression. Like, we're outside the first standard deviation for the linear regression here. That's a significant deal. We are outside the second standard deviation on a 5-year chart. That is a real significant deal for gold. That just kind of suggests that gold is very overbought. On a 10-year chart, you can see you're outside the second standard deviation here. And then if I look at the 20-year, which is very long term, again, a parabolic move here that's gone 2 standards. For some perspective, SPY has been and still is right around the second standard deviation line here. You can see, well, I guess we are still above it, just barely there. So it has also gone parabolic. Of course, IWM with this weakness has not, right? So it's a much different story. But it kind of goes to show, what's going on with what's going on with gold right now. It's for a precious metal, and even the 10-year Treasury yield is also at extreme highs right now. Granted, it's on a downward trend still on a long-term basis, but again, near the second standard deviation because of the rate hikes that we've seen. And then finally, one more asset class to take a look at on this long-term basis is the dollar. And the dollar had made a pretty decent move to the upside, but of course, not nearly as parabolic here recently, and as a result is not, it's sitting right around its actual trend line right now. So it's really not overbought or oversold. As bullish as it has been for so many weeks, really it was coming off of an oversold level to get to this point to maintain the 5-year trend more so than anything. So that's why I'm not too gung-ho about the dollar actually falling significantly here because of where it's at. In fact, if you look at the dollar here on the daily chart, we are breaking. We're still continuing lower. It's one of the reasons why the markets are so bullish today, or at least, have been so bullish lately, is because of weakness in the dollar. Of course, today, part of the reason for the rally intraday was the falling in this, but I don't expect it to drop, much further below that 200-day moving average, because again, this was actually pretty oversold, whereas now we're at these levels here are pretty much back to its long-term trend line. Now let's go to that rate of change and take a look at how gold has been doing over the last 3 months. Remember, it's up. It's got that 11% return there over 26 days. It's got a pretty good return. But here's the 3-month return for gold for GLD at least. It's sitting at 14.5%. Again, we saw that over here as well. It kind of got up to this level, kind of went sideways for a while again, and then we had some extended weakness where we had a 3-month decline. But that's a pretty, near 15% return in 3 months. That's a pretty high level. You can see other times that we've approached this level or a little bit less, or a little bit above it, ended up being a peak, especially when we've gone as parabolic. And remember that we are parabolic. You look at the DMI, which is what I kind of use to measure the parabolic nature of what's going on here, and you can see how parabolic it is in GLD, which it's not the same because it's got all the gaps associated with it. Still, its positive indicator got pretty high, about as high as it did over here when we had this parabolic run and the ADX took off as much as it did. So that's not a move you expect that would last for a significant amount of time, as bullish as it's been lately. And again, you can see the drop in yields today, helping the markets at least have the runway to overcome the negative news in the morning, to be able to come off of those lows and have that same buy the dip, rally into the close. We talked about that in my class today when the markets were still hovering near their lows of the day. We talked about the likelihood that we would actually rally into the close because that's what we've been doing. And lo and behold, that's what we did. We had a nice jump higher. You can see the yield, the MACD is actually above its moving average here, even if we're still flirting with right around the 50 and so on. So, again, the 200-day moving average is at the bottom of the Fed funds rate range. We're currently at the top of the Fed funds rate range. So we, if anything, if there is going to be any more weakness in yields, which would be very bullish for equities, then most likely it would be kind of staying within this range, which is where the current Fed funds rate is. The breadth was negative. That's not a surprise. At least it was negative earlier in the day. Let's see if it improved by the time that, it never quite got positive. It did. It was a lot more negative than this. So that is an improvement to get to only minus 1.4. But it still ended up being negative. We still ended up with net. I think, did we end up negative? We should have been negative here. We did. We ended up negative 36 on the net new highs and new lows on both the New York Stock Exchange. I mean, we're well below the average there. If you look at the new highs, right, we have to be above the average for us to be bullish. Obviously, we were clearly not today. We were well below what is already a pretty low average. For being near all-time highs, and that's the thing. we are near all-time highs. But if you look at the bullish and bearish, like we've been below the This is the historical. This line is the historical average for the bullish sentiment on the American Association of Individual Investors Sentiment Survey. Like we've been below that average for what 3 weeks in a row, and quite a few, 6 of the past 8 weeks. We've been below the average here to the downside, below the historical average, so more bearish than normal for I believe it was 12 of the last 14 weeks, including 3 straight weeks of being below 40% bearish. And again, we are near all-time highs, so it's very similar to what we saw here at the end of 2021, those last so many weeks. We also dropped below the historical average on both the bullish sentiment as well as on bearish sentiment, and that ended up being kind of the sign, the last hurrah, so to speak. And again, it's a little telling, and that's a little bit concerning that we're, in fact, when you look at the 10-week average for, let's see, where is it? It's right here. When you look at the 10-week average, it is now below zero, negative 2.25. Now, at the end of 2021, it was actually in October of 2021, we also had a little brief bearish spurt, brought the average down, and then we bounced up for a few weeks. And then what I showed you was this kind of right where my cursor is, this drop right here, that kind of pushed us down and eventually made us negative. So whether or not this drop is like the one in October or September, and then we have a bounce first, or whether it's like this one that's already negative and then leads to more weakness, I'm not really sure which one it would be, but we do need, you can see how bearish we are here. It's a big significant momentum change. It's kind of hard to offset that unless, all these other instances, we were clearly bearish on both the averages when we were this low on the MACD. So, we also got this low over here in September, October, and that ultimately led to the weakness. And that's kind of what I'm concerned about happening right now. We might have a week or two with some positive, but most likely not sustained enough to get going back above the longer term average, the 40-week average, and we end up being more bearish than we really want to be. So that's the problem with the breadth, right? The breadth is kind of reflecting this very bearish sentiment that's out there right now. And then let's take a look at the sector rotation. In fact, let's actually look at it here first. Technology is moving in the right direction, up to the right, right? The technology sector XLK is got both of its RRG lines up above 100. That is perfect. That is exactly what we want to see. It's above its moving averages here. But the problem is the other two, XLC right there, is moving down to the left. XLY is even more moving down to the left. In fact, when you look at the relationship of XLY to XLP, XLY to XLP, you can see that relationship has clearly broken down. And, the 8 and 17 have crossed the 30. The 30 is about to cross below the 50. Like we are filling in a very wide gap between the 15 and 200-day moving averages. And this is a correlation that's typically very correlated with the S&P 500. It's currently got zero correlation because the S&P is still bullish, but you can see the long-term move is clearly bearish right now. On a ratio, it's very important because, again, it's showing, this XLY compared to this one over here, XOP. And to have the 3 safety trades being in the leading sector is not necessarily what we want to see. We would much rather see XLK, which is doing great relative to the market. It's not quite above its 200-day average on a relative strength standpoint, but it's, at least it's above these kind of shorter term averages and intermediate averages, but it's not, that move is not being shared by its counterparts, right? It's mega cap sector counterparts. XLY relative to SPY is well below its averages and moving lower. It had a big gain, well above the 200, but is dropping, and you can see there. And then XLC would be the other one, and it's peaking, right, and converging with the MACD dropping below its moving average, and that's flirting with getting below the 17-day moving average itself. And you can see again how strongly correlated. So these are two sectors we don't want to see moving in this direction. At least XLC is still relatively strong from that perspective, right? Because it's still in the weakening category. XLY is the one that looks a lot worse. It's still like this relative strength is still high, but negative momentum is what really brings that down. And again, last time it came down, we ended up with one run to the upside before the actual intermediate decline that we just barely had there. All right, that brings us to our trade idea of the day, which is actually in that discretionary space. It's one of the bigger names in that discretionary space, and that is Amazon. Amazon has actually turned dark pink shading in a red line. See, XLY, which makes up, Amazon makes up a good chunk of that, is not quite there yet, but Amazon is, right? Dark pink shading in a red line, intermediate line dropping almost into bearish territory. The nice thing is we don't really have a strong bearish near-term line yet. It's in bearish levels, but it hasn't gotten into the reversal zone. So that's a relatively good sign. The market sentiment is falling, but still at bullish levels and bullish territory. Obviously, we have a bearish candle right now on, excuse me, a bearish candle with the red arrow. That means we're down below this falling 10-week exponential moving average. The PPO is falling. Still pretty decently high levels there too. If you look at the three green arrow chart, obviously we have three red arrows with a red line now on that. If you take a look at the two-line version of that chart, then you can see that we are below the 50-day. The 8 and 17-day are crossing the 30. We have a big gap in volume, a big gap in price between the 50 and 200-day moving averages, the MACD and stochastics, clearly at bearish levels. When you look at the DMI, now a lot of these are pretty bearish here, but they're not strongly bearish. Like we're not above 30 on the negative indicator. We are well below 20 on the positive. The ADX is rising. If you look at the RSI and the CCI, neither one of them are at strong bearish levels. We're still above 40. We are at the lowest level it's been in for multiple months, but we're still above 40. We never really did cross minus 150 on the CCI. If I take a look here at the Ichimoku cloud, we are still above the cloud, flirting with the top of the cloud. We still have a positive rate of change. We don't even have a weak trend. Now we're almost there, but we don't have a weak trend even developed yet. And then finally, when you look at the Bollinger Bands and the Keltner channels, you can see that we are in the lowest quartile of a rising bandwidth that's maybe one more day away, maybe two, from getting green dots with some pretty bearish momentum. So clearly a bearish patterns, but not strongly bearish. What I decided to do here was to sell the 30, was it the 230, buy the 235. This should be this way: sell the 230, buy the 235, and put. You can see position sizes. Let's get this position size. Let's do this. There we go. Position size for the full position. Getting a pretty decent return. It's got to be at least $1.16. I think we're getting like $1.40. We ended up getting $1.44 on that. So well more than, and you can see that break even is sitting right here, back up above the moving averages. So if Amazon changes this sentiment and turns bullish again, back above all the moving averages, then we don't want to be in a bearish trade anymore. So we'll be fine with closing out our trade in that particular case, and ideally taking no more than around that $430 gain. We don't want to take more than that for a loss, even though we're positioned for a $1,000 loss at a max. We ideally don't want to lose more than this 430 because it makes it easier to make it back if we don't lose that much. So that's kind of what we have going on with our trade with Amazon. So one of the rare short verticals that we've done here lately in these videos, but it gives us a little bit of a balance from a theta standpoint versus with all the long verticals that we've been covering day after day in our Market Outlook live videos, in terms of whether, in fact, we actually closed out a couple of them today, but we still have a long list of trades from all these prior days that are sitting still outstanding going into both February and March expiration. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, join us at marketscholars.com for free, follow and like us on Twitter and Facebook as well. Have a great rest of your Thursday night, everybody, and we'll see you all tomorrow.